Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to continue the series of discussion to determine whether this share is still a good buy or not. This video is slightly different. So this video, I'm going to introduce another parameter which is known as current ratio. So the formula to compute this current ratio will be equals to the current assets divided by the current liabilities. So basically this is actually a very short term to determine whether the company financial health is okay or not. So basically for this video, I'm going to use a startup, how to use this current ratio to determine whether this startup is still worth to invest or not. So basically this will be the objective of this video. Before I continue, guys, I'd like to urge you guys to help me by like this video. Guys, just a few seconds, help me press the like button now. For those who are new to this channel, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. Let me do a very quick disclaimer. So this is not a financial advice. This is mainly for education. So therefore, please conduct your own independent research and consult a professional if needed. Never invest more than you are willing to lose. With this, we are ready to kickstart today's discussion. How to tell if this stock is still a good buy? So basically, all these parameters, basically they will give you an understanding whether the share price is still reasonable or not. So basically, this actually determines the valuation of the company. Next will be on the financial health and also the stability of the company. This video, I mainly will focus on current ratio. So basically, current ratio is mainly for short term. For example, if you plan to invest into a company in a short-term basis, you can use this current ratio to determine whether the company is worth to invest. Also, probably you want to invest into a startup, but they have limited so-called favorable data for you to determine. So basically, in short, you can also use this current ratio to determine whether this startup is worth to invest or not. So basically, later on, I will give you an example how to determine this startup whether it is still worth to invest or not. Next will be on the profitability. So this is the most important in terms of the company. So how much profit that they can actually generate. Last but not least, in terms of the growth aspect, what are the potential of the company? So basically, these are the series of discussion that I'm going to go through one by one with you, how to determine if this stock is still a good buy or not. Let's come to today's topic, which is current ratio. What is actually current ratio? So current ratio is a basic liquidity ratio that shows whether a company can pay its short-term obligations with its short-term asset. So basically, in short, this is actually the formula to compute the current ratio. Basically, will be the current asset, whatever asset it has, divided by the current liability. For example, the employee paycheck, the raw material, etc. Basically, with this, you are able to tell, let's say that there is a bill that is going to due in a year time, whether the company is able to cope this bill or not. So in short, this current ratio, in fact, measures a company's short-term financial health. So basically, this actually gives you some confidence, whether this, let's say you invest into a new startup, whether this startup is able to cope this in terms of a short-term financial health. How can we actually interpret the current ratio? So in short, we want the current ratio to be bigger than 1. So with this bigger than 1, this means that the company has more current asset as compared to the current liability. This simply means that the company, in fact, is on good health. Next, when the current ratio is equal to 1, which means that the current asset is exactly equal to the current liability, which means that everything just nice, balanced. When current ratio is less than 1, this actually back up a red flag. This means that it actually potentially liquidity risk. So this become a big issue. Come to the typical benchmark. So basically these are the rules of the thumb. For example, as I mentioned earlier on, the current ratio, we want it to be bigger than 1. Typically, we want it to be 1.5 to 2. So basically these are what we call a comfortable zone. When this current ratio is too high, which means that they have more current asset as compared to the current liability, this simply indicate that this is actually inefficient use in terms of the assets. Next will be too low. Okay, so basically this is what I mentioned is undesired. This means that they have the potential issue to pay the debts. Okay, therefore it become a big issue. Coming to the example, okay, let's say if the company has this current asset, okay, 200K and current liability 100K. Okay, I guess you know how to compute this current ratio will be equals to the current asset divided by current liability. So therefore will be 200K divided by 100K. This gives you the current ratio to be equals to 2. Okay, so this means that the company has $2, okay, in terms of the short-term assets for every $1 of short-term debts. This means that the company will be able to cope. Let's say they have a debt to pay, okay, in 1 year times. Let's take a good look where can we actually apply this current ratio, which specific company. For example, current ratio will be good for manufacturing and industry company, and also for retailer and fast-moving consumer goods company. Why? Okay, because all these company they have a huge asset and also a huge liability. So therefore, when we actually use this current ratio, it will be able to indicate whether the company is confident to pay the bill or debt or not. So basically, this will be very useful for those that has huge asset and also huge liability. Another sector will be the small cap and mid cap company. Why? Because all these companies they has less access to cheap funding. Therefore, the liquidity risk is higher. So therefore, we have this current ratio to help to spot financial stress firm actually early. Next, construction and infrastructure company. Okay, so basically this company actually operate in a project base, and therefore we have this project based cash flow. Basically, it's going to have a high short-term liability. Hence, this current ratio will be good because it is always very important to check the current ratio before we start to invest into the company. Next, okay, what work poor for current ratio? Firstly, will be bank and financial institution, okay, because their balance sheet work differently. Okay, the deposits is equals to the liability and the loan is actually equals to the asset. Hence, current ratio is not useful. IT and software company, they have a very low inventory or very low asset and they have high cash reserve. Hence, this very high current ratio, they are normal and not insightful. Next, for asset likes or cash rich giant, okay, basically they can operate with low current ratio safety. Hence, don't judge them harshly on this metric alone. Okay, before I continue on the discussion, how can we actually use this current ratio to determine whether this startup is worth to invest or not? I need your help, guys. I need your help to like this video and subscribe to this channel. Guys, help me by subscribing to this channel and like this video if you have learned something from this discussion. Let's continue on the discussion. How can we actually use this current ratio to determine whether this startup is still a good buy or not? Let's understand the typical startup current ratio scenario and what they actually meant. So basically, just now I mentioned that for current ratio, there are possible 3 scenarios. The first one will be desire when the current ratio is more than 1. When current ratio is equals to 1, this means that the current liabilities is equals to the current asset. As for current ratio less than 1, this is actually a red flag. Let's take a look on this startup in order to understand this. For example, let's come to the first scenario where there is a very high current ratio. Let's say that more than 3 or even more than 10. Okay, so what it actually look like? This look like a massive cash balance. Basically, from recent funding round, these are very few liabilities. What does this actually mean? This is normal and often good for an early stage startup. This means that the company is well capitalized, has a long runway, and can focus on growth, product developments, and hiring without immediate financial pressure. Let me give you an example. Okay, for example, a seed stage SAS company just raised this $2 million. Okay, its balance sheet show as below. So the current asset will be equal to 2.1 million. Okay, because recently they just secured a fund of $2 million, and therefore they also have this prepaid expenditure of $0.1 million. So let's come to the current liability. Let's say the company has this $0.1 million of current liability. So this work out the current ratio to be very high. Okay, you can see from here is 21. Okay, so what can we actually interpret this 21? This is extreme high liquidity. The key question become, what is the money burn rate? For example, let's say the startup has this 100K per month of burn rate. Okay, so this ratio actually show that they potentially have 20 months runway, which is very strong for a startup. So basically with this, you can sense that the startup will be worth buying when their current ratio is in fact very high. Next, let's come to the scenario 2, very low, okay, which means that a red flag or deteriorate current ratio. Okay, what does it look like? Cash is running low. Liability like vendor debts, deferred revenue, short-term loans are all piling up. What does this actually mean? This is actually the number one red flag for a startup. It signals the runway is actually shortened, okay, because they are having more liability, their runway will be shortened. The company is at risk of not being able to pay the employee or vendor. Urgent action is needed, either cutting costs drastically, okay, by extending the runway or raising the new capital. This is the most critical use of the ratio for a startup, for founder, and maybe also for the CFO. It is a vital dashboard metrics for survival. Coming to the scenario 3, okay, will be the current ratio, which is around 1. What does this mean? Okay, again, this can be spelled danger zone for a startup, okay, because it's just nice for a startup. This is a state of immediate crisis, okay, not neutralized. Okay, it suggests that the company is weeks or days away from being unable to meet its obligation. Immediate intervention is actually required. Let's do a quick conclusion, okay, for this startup. Yes, typically we can apply this current ratio for a startup. Okay, because this formula, current asset divided by current liability, it is a very important, non-negotiable financial health metric. However, refrain its meaning. Okay, so for a mature company, a very high ratio can signal inefficient because they are going to have a lot of asset but less liability. This means that it has not efficiently used in terms of their asset. For a startup, a very high ratio signal this security and runway. In short, they are generally good. A low ratio signal actually in a very high risk. Always pair this with your burn rate and runway calculation for the full picture of your startup financial timeline. With this, I'd like to end my discussion. Please help me to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.